Welcome back to the deep dive. Today, we're going to dig into something that's probably on a lot of minds right now: market volatility, especially with all this chatter about a possible growth scare on the horizon. You know, that feeling when the market seems like it's on a caffeine-fueled roller coaster? We're going to explore how to stay cool, calm, and collected, even when the market feels anything but.
That's right. We're not about making rash decisions based on fear. We're all about making informed decisions based on, well, good information.
Exactly. And our guide for this deep dive is a report from mapsignals.com by Alec Young. It's called 2025 Volatility Playbook 3 Studies to Keep You Invested. Hopefully, by the end of this, you'll be a lot less tempted to hit that sell button every time the market takes a little dip. So, the report sets the scene. Stocks have been on a pretty good run since late 2023, but things are getting a bit choppy lately. And the culprit, this growth scare everyone keeps whispering about. But what does that actually mean, and should we be freaking out?
Well, a growth scare basically means economists are getting worried about a significant economic slowdown. And one factor Young points to is the impact of the Trump administration's policies. He makes an interesting point about how stimulative policies like tax cuts usually need congressional approval, and that takes time.
Right.
But restrictive policies, things like tariffs, those can happen much faster, through executive orders.
So it's kind of like slamming on the brakes while the gas pedal's still down. Sounds kind of bumpy.
Yeah, it definitely adds to the uncertainty. When businesses and consumers don't know what's coming next, they tend to hold back on spending and investing, which can snowball into a slowdown of economic growth.
Makes sense. And it seems like there's some data backing up this fear. The report mentions something called the City Economic Surprise Index, and it's dipped into negative territory recently. Can you break that down for us? What does that mean, and why should we care?
Sure. The City Economic Surprise Index basically tracks how economic data is performing compared to what analysts were expecting. When it's positive, the economy is exceeding expectations, doing better than predicted. But when it goes negative, like it has lately, it means the economy is actually doing worse than folks thought. And that can spook investors because it suggests things might be slowing down more than initially anticipated.
Okay, so we've got this growth scare and some data hinting that things might be worse than predicted. I can see why some people are starting to sweat a little bit. But before everyone runs for the exits, Young presents a pretty compelling case for staying calm. His first point is that slow growth doesn't automatically equal doom and gloom for the stock market. Can you help us unpack that?
You got it. It's easy to think, oh, the economy's slowing down, the stock market must be about to tank. But if you look back historically, that's not necessarily true. The report highlights that since 1970, the stock market has actually generated positive returns even when GDP growth was between 1.5% and 3%.
Interesting.
And get this, even when growth dipped below 1.5%, as long as it stayed in positive territory, stocks still managed to churn out an average annual return of around 7%.
7%. Not bad considering. So it's not the slowing growth itself that we should be losing sleep over, but rather the dreaded R word.
You nailed it. The real danger zone is when we slip into negative growth, a recession. But as long as we're still seeing positive growth, even if it's slow, history shows that stocks can still do pretty well.
Okay, that's a good dose of historical perspective, but I know a lot of people still get those nervous jitters when they hear rumblings of a possible recession. What's Young's second reason to stay cool?
This one's all about the Fed put. Basically, it's the idea that if things start to go south, the Federal Reserve will step in to support the market, like a safety net.
So the Fed has our back, kind of like a financial superhero swooping in to save the day. How does that actually work in practice?
Well, one of the Fed's big tools is adjusting interest rates. When the economy is struggling, they can lower interest rates. This makes it cheaper to borrow money, and that encourages people and businesses to spend more.
Right.
But here's the thing, that weaker economic data we were talking about earlier, it might actually push the Fed to cut rates sooner rather than later.
Wait, how is that a good thing? Doesn't that mean the economy is in trouble?
Well, rate cuts can be a sign of economic weakness, but they can also help to prevent a full-blown recession by getting things moving again. It increases the chances of a soft landing, meaning the economy slows down gradually instead of crashing.
So the Fed cutting rates is kind of like easing up on the brakes before we come to a screeching halt.
Yeah, that's a good analogy.
I'm starting to get a better grasp on this whole Fed put concept, but at the end of the day, isn't it company performance that really drives the stock market?
Absolutely. While things like interest rates and economic growth definitely play a role, it's ultimately company earnings that determine stock performance. And Young actually illustrates this point with a really cool chart in his report. It shows just how few events actually have a big impact on company earnings over the long haul.
So while the headlines might be screaming about doom and gloom, the underlying fundamentals of companies are often still pretty solid.
Exactly. And that brings us to Young's third reason to stay calm amidst market volatility. It's about not letting yourself get carried away by those constant recession predictions. There's that old saying on Wall Street, economists have predicted 9 of the last 3 recessions.
Yeah, I've heard that one. So maybe we shouldn't be hitting the panic button every time someone predicts a recession.
A little healthy skepticism never hurts. Young's report really drives home the point that most of these market dips, the ones driven by fear, don't actually turn into those big, bad bear markets. They're more like pullbacks, temporary setbacks that are just part and parcel of the market's natural cycle.
So like a roller coaster. There are dips and drops, but the overall trend is still upward.
That's a great analogy.
Hmm.
And historically speaking, those truly ferocious bear markets, the ones everyone dreads, they only happen, on average, about every 7 years.
Okay, that helps put things into perspective. And when they do happen, how bad do those drops usually get?
Well, the average bear market decline is about 30%. But most drops are actually a lot smaller, more in the 5 to 10% range. And importantly, they tend to be followed by pretty quick recoveries.
Okay, hearing that makes the roller coaster analogy even more fitting. So we've got some solid reasons to stay calm. But I bet a lot of our listeners are thinking, all right, that's all well and good, but what's the smart move right now with all this uncertainty? Should I just play it safe and park everything in cash?
Well, going completely defensive might feel safe in the moment, but it could mean missing out on opportunities when the market bounces back. The report actually recommends a more balanced approach. It's not about abandoning the market entirely. It's about being a bit more strategic, a bit more picky with where you put your money.
So not running for the hills, but maybe just being a little more discerning about where we invest.
Exactly. And this is where focusing on high-quality companies really comes into play.
Yeah.
You want to look for companies that are built to weather the storm, no matter what's happening in the broader market.
That makes sense. So instead of just shifting everything to those traditional defensive sectors like consumer staples, utilities, and healthcare, we're looking for companies with certain qualities that give them an edge in uncertain times.
You got it. Young highlights companies that have strong earnings, low debt, solid balance sheets, and consistent dividend growth. Those are all signs of a company that can withstand some pressure.
We've talked about the first three, but for listeners who might not be quite as familiar with the lingo, can you break down why dividend growth is such an important factor, especially right now?
Sure thing. Dividend growth is a really good indicator of a company's financial health and its commitment to returning value to shareholders. Companies that consistently increase their dividends, those tend to be the more stable and reliable ones, which can be especially reassuring when the economy feels a bit wobbly.
So it's like a signal that they're not just surviving, they're actually thriving, even when times are tough.
Yeah, you could say that. It's a strong indicator that can give investors more confidence.
So instead of trying to time the market perfectly or making any big sweeping changes, Young's strategy is about staying invested, but getting a bit more selective, focusing on those companies that have a proven track record of solid performance, even when there's a lot of uncertainty swirling around.
You nailed it. And it aligns with the 3 key takeaways we've been discussing. Slow growth doesn't always spell disaster for stocks. The Fed put could act as a buffer if things get really choppy, and those scary recession predictions are often more bark than bite.
This has been a really insightful deep dive, but before we wrap up, what's that one big takeaway you want our listeners to walk away with today? That one thought they should be pondering as they look at their own portfolios in light of all this?
It really makes you think, with all this talk about a growth scare and a potential recession, and given how resilient those high-quality companies tend to be even when things get rough, it begs the question, is now the time to get even more selective? Really double down on that quality and build a portfolio that can handle whatever might be coming down the road.
That's a really great question for our listeners to consider as they navigate these, well, kind of uncertain markets. It's easy to get spooked and make those impulsive decisions. But this deep dive, hopefully, has given everyone some good knowledge, some historical perspective. Stay calm, focus on the long game, and hey, maybe even use this volatility to your advantage. Strategically add to those positions in those high-quality companies.
Exactly. Market ups and downs are going to happen. It's all about how you react that really makes the difference.
Couldn't have said it better myself. So until next time, stay curious, stay informed, and happy investing.